So welcome everyone to presentation training. What do investors really want to hear? The reality is the reason why you go and build and start your business and do the hard work day in and day out is a lot different than why an investor would choose to invest. I just recently had the opportunity to listen to Matt Oppenheimer speak. His company just went public this week with Remitly, a Seattle-based company, and he spoke to a EO group of us a few weeks ago. And he was talking about his process and what he had gone through. And there were some interesting tidbits that I pulled out of there that really helped me to engage better from an investor point of view, because for him, day in and day out, it was customers and problems. Just as long as he came back to the customers and solving the problems, he would be able to succeed in everything he was doing. Now, from the entrepreneur point of view, that's fantastic. That's what you need to be focusing on. But from the investor point of view, what we're looking at is how do we make money? And I'm just putting it real bluntly. We want to advance technology. We want to do good in the future, but we are an investor and we're here to make money. So who am I and why, do I have any credibility at all to, host this presentation training? So I am Brianna McDonald. I am the president for Caretsu Forum, Northwest and Rockies. I've been angel investing for 15 years. I wrote my first check at 26 years old into a little Seattle-based company here. Still going today, learned a lot of lessons from that investment. I did receive a return, but it was only 2x in 12 years. So there was a lot of learnings that came along with that first investment. Since then, we now have 25 companies in our personal portfolio, and I've helped facilitate more than 200 million into 250 companies since 2018 and coming on board as president. And so really, I cultivated this presentation training because I was so tired of listening to these awful pitches from entrepreneurs. And it wasn't because they had a bad business. They just couldn't talk about the business in a way that I understood it or that I saw it as an investment opportunity. So I wanted to help and create this training for companies that do present. We are a part of Caretsu Forum, which is a global network. We have over 55 chapters on 4 continents. We have over 3,000 members globally, and we have funded more than 1,100 companies to date. Additionally, we are a very active investment organization, investment network. You can look at these PitchBook statistics from both 2019 and 2020. In 2020, we weren't sure what was going to happen. We'd been hosting all of our events in person in 2019. And in 2020, when everything went online, our members engaged with us, rolled up their sleeves, got to work, and put their money where their mouth is, and really put those funding dollars in action here. If you look at the people that we sit on this list with, they're all large funds. There's actually no other investment networks that sit on the top of this list. So we feel very honored. PitchBook scrubs all of their data. And we love our members and the work that they do to contribute their time, their efforts, their talents to really supporting innovation. So we have a very specific funding gap here at Caretsu Forum, and it's really important to know as an entrepreneur who you're going at, what time, what they like to fund, what's their investment thesis. There's a lot of research that needs to be done on your end. And just starting off with any group or just cold emailing people through LinkedIn or, it doesn't work really well. It's all very relationship based. People invest in people they know and trust. So do your research, figure out who your local angel groups are, figure out who the ones that like the pre-seed, the seed. We typically fit a little bit later stage, which is really good for the entire ecosystem. We need funders at each stage in the process. And as companies have really developed over the last 5 years, there's been separate tracks of companies that have developed. There's been the VC track, which are companies that want to just burn endless amounts of cash. They can get big funding dollars. The VCs come in, they help raise their rounds. They put in a lot of capital and they just burn through, and maybe one day they'll generate and earn some money in return. And then there's the groups and the companies that come through more the private investment route that look for the earners. They're looking for companies that, are really chugging along, making revenue. We don't need to go find the unicorns every time. I'm not out unicorn hunting. If one crosses my path, we're certainly excited about that. But we're more looking for the singles, doubles, and the triples. So typically what we fund is late seed, Series A, Series B, Series C, and we leverage more family offices and our syndication to do so. These statistics are a little bit dated, but one thing that is still very true today is the funding dollars and how they divide. And I just want to point this out to you as you think about your capitalization plan and who are the investors that you want to bring onto that cap table. VCs put 130 billion into just under 9,000 companies, whereas private investors put 23 billion into 66,000 deals. So there's a lot more accessibility to capital. There's a lot more ability to diversify your cap table, that expertise that you can pull from there with what fits your company and what you're looking to grow best. Now, I mentioned that people invest in people they know and trust. We have a very structured investment process at Caretsu Forum. This has been this way for over 20 years. We have applications. They come in, they go to our committees as well as internal review. Everything is reviewed up front. It's a very member-driven process. And then they go to deal screening. Once again, our deal screening, our members choose which company goes onto our forums. At our forum meetings, we facilitate between the investors and the companies, collect the interest, and send them on to due diligence. From due diligence, the team is put together by the entrepreneurs, really you getting to know who they are and them getting to know who you are, how you show up, and if this is something that is going to work with their investment thesis and it's something that's going to work for you on your cap table. If you are successful with all of that and can raise more than half your round, you can apply to Keiretsu Capital for a top-off round. This process does take time, and it's not something that's quick and easy. One thing that companies complain about the most is our due diligence, because it's thorough and it takes time and effort, and typically you want it done yesterday. Our investors love our due diligence process. So the one thing I would just have you think about as an entrepreneur is, and as you're getting started, is building out that deal room. The more ready and prepared you are to speak to investors, the more information that you can have available to them, the more ready you're going to be to take on that capital. Our process really helps to set you for the next stage of diligence, because a company moves through a life cycle as it continues to grow, and your diligence is going to get more and more stringent as you continue to move further and further into the company life cycle up to exit, which, you know, that diligence process can take up to a year, sometimes 18 months. So keeping in mind, everything happens just as it should, and there is a process in place and it does work, and following what works best for your business is critically important. All right, so let's get to the crux of it here, creating a fundable pitch. And I just have some hints for you. It's actually not about the pitch. You're not going to raise capital off your pitch. I have seen on like 2 occasions over 15 years, an investor see a pitch and write a check. And I always wonder, really? You're not going to ask any more questions? It's about generating relationships, about getting to know people. It's about understanding who those investors are, talking about things at a high level, not going into the weeds, and getting those follow-up calls. So it's a great milestone. And when I started my business, I was sharing with some entrepreneurs on the line as we got started here. I had to go out and raise $1 million. And that was really daunting to me. If someone had just told me early on, if all you want to go do is get 10 interested people into your business, get 10 interested people to follow up and have coffee with or to talk to, that is a much easier milestone, something easier to chew off than saying, I have to go raise $1 million. And so how you build those relationships and get those doors open is really important. All right, so I talked a bit at the top of the hour about knowing your audience. So what is an investor? An investor, by Webster Dictionary, is a person or organization that puts money into financial plans, property, etc., with the expectation of achieving a profit. This is how it is defined. We are not charity. I am not a philanthropist. There are lots of places I could go and donate money to. That's not what I'm doing here when I look at your company and your investment opportunity. And so as I go through this presentation today, this is the point of view I am coming from. This is what I'm looking for from the companies that present to us. And I can smell fluff. at any part of the presentation. And if entrepreneurs are looking to kind of put things under the rug or give me an opportunity for a gotcha question and are not going to give me the full answers or results, I will typically move on to the next company, because even though you're all in this together, you are all competing against each other for capital. So let's get kicked off here. There's a few core items that need to be a part of your pitch that isn't necessarily the context in your pitch. It's who you are. It's how you show up. And you can do this on Zoom. What is your purpose? For me as an investor, this comes through in the inflection in your voice, how you're speaking to the audience, speaking to what you know, what you don't know, and really how you came forward with this idea. Is there a personal story that comes with this? Your purpose is what gets you up early in the morning to work and what keeps you up late at night. This is your gasoline in your tank that's going to keep you going as the CEO of the company and the leader that I'm going to want to invest in as I continue to go forward. And so really seeing how this comes through in your pitch in unwritten words. Next, you need to eliminate red flags. Call out that elephant in the room. Don't leave it to me to ask the question about it. If there's something that isn't amiss with your business right now, that's okay. Guess what? You're a new company. You're an early stage company. There is a whole lot of problems that you're going to face down the road. And being able to have insight and knowledge and speak to those up front shows authenticity, shows that you're trustworthy, shows that you know what you don't know. Don't be afraid of this. I don't need a polished pitch that looks perfect. I don't need the CEO to have an answer to every single question. What I want to see is honesty come through here. And being able to talk about the challenge points along the way, being able to talk about the gaps in your business and what that next hire is and why. So think about this as you go through the presentation. And then as you go through it, demonstrate competency, because those are the things that we're looking for. Your slide deck is your tool that you can use throughout your presentation. And your presentation isn't just limited to 1 minute or 3 minutes or 5 minutes or 10 minutes, whatever it is. There's usually a Q&A that follows. The entire time you have up in front of the investors is your presentation. And I would stress the question portion of the presentation is more critical than the presentation itself. Use your deck, have the backup slides. Don't ever delete a slide. Just throw in the appendix. You spent time, energy, effort in building it. And you never know when you might need it again. Why recreate the wheel? But understanding that that whole space is critically important to use. And if you show up and you have purpose and you are authentic and you answer the questions thoughtfully and demonstrate competency and you have good deal terms, you will be successful and you will raise capital. And I've seen it happen time and time again. And it's really what good leaders are made out of. So in creating your deck, and now keep this in mind, nothing is black and white, right? In entrepreneurship as a whole, nothing is black and white. There's a lot of gray area. So this is the general flow that I like to see in a deck. And what I love about this is that each slide builds on the next slide. Also, the slides at the top of the deck are, I would say, are probably not as important as the slides at the end of the deck. And you'll see that as I go through the presentation today, I spend a substantial amount of more time on the end of deck slides. And that's because that's what we remember as investors. It's how it impacts us as investors. And it's where the rubber meets the road. So I like to think of this like a great script that you see with a movie, like Game of Thrones, the character development, each slide kind of building on the next slide, which flows into the next one. The challenge is, and you really need to look at group to group where you're going, what their recommended slide deck order is, because their investors have been trained to hear presentations in a certain way. And I understand that you might want to be creative and cute and like stand out in the crowd, but what that ends up doing is leading to a lot of confusion with the investors, because if you all of a sudden, start talking about your solution before you talk about the problem, or you start talking about your competition before I really understand your go-to-market strategy, all I'm going to be thinking about is your go-to-market strategy and what you're doing and how that matters to competition. And if I start thinking, that is your worst nightmare. as an entrepreneur because I've now stopped listening to you pitch. We can kind of multitask, but we cannot multifocus. It's why we can't text and drive at the same time. It's why it's really hard to listen to two conversations at the same time. And so how do you keep those investors as focused as possible as you go through your pitch? So we have the first slide. I like to call this the overview slide. It sets the foundation for everything I'm about to hear today. I can't tell you how many times I got through a presentation and I didn't understand what their company was, what they did, or why they were standing in front of me. Seriously, they didn't ask for the money. So tell me up front who you are. Why are you the person standing in front of me? Are you the CEO? If you're not the CEO, you better have a good answer to why the CEO isn't presenting the business, because the CEO should represent the business. So who are you and why are you there? The name of your company. This is important, usually a logo. We think in pictures. You're going to hear that quite often as I go through this. What your company does, just a real quick thing, right? I have a B2B SaaS company. Super. I now understand as an investor exactly why what I am listening to, and I'm here raising $500,000 on a convertible note. I don't need any more deal terms than that. I just need to know why you're here. And then the foundation is set for you to go into the rest of your presentation. You got the main things out of the way that you are listening for as the investor. All right, now take a moment and look at this woman. Do you feel her frustration? She is done listening to awful pitches, right? So you need to use these pictures, and we can thank Apple for the fact that we think in pictures. We do not think in words. So if you have a problem slide and it's filled with words, and frankly, if your deck is all words, great, save that and use it for an investor deck you send that some investor is going to read. For the purposes of presenting to a group, use pictures. You're drawing people in emotionally to what you're doing. You're trying to captivate an audience. What is the problem you're solving? What is the pain point here? That's it. I don't need any more. Because honestly, as much as you care about the problem, and as Matt Oppenheimer told me, all I think about is problems and customers, I don't care about the problem. I am investing in the solution. That is what I'm investing in. So I do not recommend typically more than 30 seconds being spent on this slide, and that is in a 10-minute pitch. So we want to know that a problem exists. We don't want you to be a company necessarily searching for a problem, but we don't really care about the problem. We also typically probably already know the problem exists. So let's say you have a clean tech company. We all understand climate change is a thing. So you don't need to spend 2 minutes talking about the impacts of climate change. We're just interested in your solution. So let's get to that. This should be a couple of slides. So what is that solution? How does it combat that problem that you just got done speaking about? And is it really solving that current pain point in the market? And why is your solution going to be better over what's currently out there? Whatever this may be, this is done on a generic basis, whether it's clean tech or consumer goods or a medical device. But give me some meat here. This is what I'm investing in. Show me happy people using your solution. It really helps to bring in the investors more to what you're speaking about, especially through a virtual platform. And then once you get done outlining what your solution is, how it works, what it does, and why it's better, then you move into your market. So this for me is a red flag slide. This is the first red flag slide that I have in this deck. I have a few different red flag slides. This slide is critically important to me because it ties directly into the financial projections. And you might say, well, why does that happen? Well, because the way you're able to talk about your market, I will be able to see how you're able to grow, because your financial projections are that. They're just projections. So how you build this up and start from here as you go into your go-to-market is critical. Now, if you tell me you have a product that is meant for every single person on the planet, I will typically write you off because you are a small little startup and there's a lot of big behemoths out there and you are unable to boil the ocean. So what I like to do is I like pie charts here. I like starting off big with the TAM and giving me that total addressable market and who it is, and then really boiling it down and pulling out that little sliver of this is my target market and this is where I'm starting and why. Stay focused, because this slide really can show your ability to scale and can complement your financial projections well. So just stay really focused here as you move forward and dial it down, because the next slide then builds off of that. And you pull that little target market out, and then you talk about how you bring them on as customers and how you're going to get traction. What is the business model? Is the product complete? Have you built out an MVP? Where are you at with that? Talk about your market research, your COGS. Who are your current customers? Who is in your pipeline? What's your sales strategy? And then everything with all of these different pieces in your go-to-market strategy needs to be backed up. Our business model is this because we went to the market and we talked to the market, and this is what the market wanted. We surveyed this many people. And by doing this, we have now closed this many customers, and we have identified these other customers here that we're going to be going after next. Now, maybe down the road, we can go into these other customers, but stay focused on where this capital is raised that you're raising with this pitch is going to be going towards. So not getting too far ahead of yourself. You can mention things about the big picture overall, but really keeping it dialed into what this is. If you're manufacturing something, where are you manufacturing it? How are you dealing with quality assurance? How do your COGS work out? Cost of goods sold, just to make sure don't use acronyms. People tend to make things up, but this is really important. These two slides here are typically missed in most company presentations that I see early on, and this is what we fund. This right here is what all the dollars is typically going to. There's a little bit of development that's happening for Keiretsu, but for the most part, the ramp up and the scale up is what we're looking to fund. So please keep this in mind. And if you need more slides than this, that's fine. So you're able to then really build out what your solution is, what your market is, pulling out that target market, building upon that in your go-to-market strategy, and how you're really going to do the hard work to get the boots off the ground here and go forward. Now, the next thing you really need to do as you continue to go forward and out into the marketplace, because there's others out there doing similar things to you, is you need to build a moat around where you're at. What is your moat? And how do you protect that? Do you have IP? Do you have trade secrets? Now, this question always gets asked, 100%. So I don't feel like this slide is something you need to spend a lot of time on, because you can almost guarantee that in any moment, an investor will ask this slide in Q&A. So, but being able to touch on it, have it there, and then refer back to it in Q&A is important. It also helps to just build the storyline around as you just got done talking about your go-to-market strategy and then how you protect your business and protect what you're doing, because it's going to ultimately also protect the investors if they choose to invest as you then move into competition. So this is another one of my red flag slides. Competition, and Amber, usually I get by, if her camera's on, she'll smile because I always say this is my favorite slide. Now, if you would have asked me this when I was an entrepreneur and wearing your hat, I hated this slide. I thought it was awful. I was terrified of my competition. And I was terrified because I had no barriers to entry. There was nothing I could do to protect what I was doing. And so I was very, very fearful of what I was bringing out into the marketplace and just basically being squashed like a little bug at any given moment. But what I have come to learn over the last 10 years is that competition is critically important. One, they've already trailblazed for you. Now, we do have some trailblazers out there, and for you, God bless you, because it is hard to be a trailblazer. It is a hard road to create that path and do that, and keep going forward if you're doing it. But identifying competition is critical because they've blazed the trail. Go and learn from them, study them, understand what they've done, what mistakes have they made. Really being able to see what you are not going to do as you grow your business, how you can save dollars and put them elsewhere by not making the same mistakes as them. Also, they might buy you. They're critically important. Befriend someone in your competition. And I don't say that in ways of like giving up your trade secrets and other things, but The more you spread the love around and you bring on and create a key relationship, once again, that word relationship, and bring on advisors in some of your competition businesses, they now have an understanding to what you're doing, what you're building. And you can pick and choose what information you give to them. But it could help plant the seed further down the road. And when you then sell your company and exit, guess who wins? That advisor as well. So figuring out your strategy and what works for you and how you're able to help support the growth of the business is critically important, those key relationships and people that you can bring on. I typically like to see this slide in a quadrant slide. Our eyes track from left to right. There's a reason why whenever you see a competition slide, the company presenting always lands in the right-hand corner. That's why. It's where we sit and what we look at. Figuring out what the two metrics are that you're measuring and how you stack up. Also, if you do decide to use checks or X's, keeping in mind color is another way that we also communicate through as humans, and making red X's and green checks. It just makes it easier to see as investors and really makes it stand out so we can understand clearly how you've done your research, where you sit, and how you stack up with your competition in the marketplace. So do not skip this slide. The other thing about this slide, I feel like entrepreneurs get really into the weeds here on competition. Like I saw a business plan once and they created a bracelet that you could put a key in. And so in their competition, in their business plan, they listed off 3 other bracelets that hid keys. And I was like, well, what about a pocket? Or what about a purse? There's status quo and there's things that are currently going on out there. Changing human behavior is really, really hard. So call out the most mundane competition that there is, because you're going to be changing human behavior in some way, shape, or form. And just keep that in mind, because investors will plug holes in that too. All right, so after competition here, this is where we really get into the crux of probably the most important slides of the presentation. And you'll see, because the remainder of the time will be spent in these slides. So we go into financial projections. Now, we need to see growth. If you start building out your financial projections and you understand your market, you understand your go-to-market, you've been working with your advisors and you're building your line and you're building your line and you're building your 5-year financials, and you're just not quite seeing that hockey stick, don't inflate your numbers. Don't be like, oh, well, the investors want to see this. You need to be realistic with yourself. If you're growing this and it's not growing at a scale that's really going to provide a good ROI for investors. There are lots and lots of different types of businesses out there. And so keeping in mind that raising capital from investors might not be your best avenue for what your product is. So have a clear understanding of your market and your metrics and how they work together, and making sure that you're being thoughtful about that. Because if you don't have to go sell off your business, and if this is something you potentially just want to run for a really long time and you're just really passionate about it and you want to do that, maybe raising capital from others isn't the best avenue. So just something to keep in mind as you move through these projections. Also, use of funds, how they add in, and your capitalization plan. You can talk about different inflection points as you talk about your financial projections, and that's fine. But we really want to see that growth, and we want to see how you grow over a 5-year period of time. And lastly, provide me real numbers. We use lots of funny words, and I don't know how this all came into play with presentations, but in my previous life in real estate, we called them weasel words. And it's words that are adjectives that actually say nothing about what you're doing. I have conservative financial projections. Awesome. What does that mean? Conservative how? Conservative in customers, conservative in dollar amounts. As an investor, it's like fingernails on a chalkboard. This represents 5% of my total addressable market, or this represents 5% of that target market in the first 3 years. Give me what the numbers are. Don't try to fluff it up we're professional investors. We'll sniff it out. And so, once again, as being as upfront and transparent as you can be about your numbers is critical in building trust with these investors to gather that interest and bring them on the call. So know what this is. Also, year 1, year 2, year 3, year 4, year 5. Great. Was that like in 2006 or is that in 2030? Give me the actual years, 2021, 2022, 2023. I'm not going to be guessing. So please be as clear as possible. And once again, understanding that these financial projections tie back to your market and your target market that you're pulling out. So knowing exactly how many customers you're bringing on at each given time and when those use of funds kick in with your different stages of growth, how that's really able to help you scale up quickly to get to that exit. Next, team. Team, the most commonly skipped over slide by entrepreneurs. Do not skip over this slide. You know why you end up skipping over this slide? Because you ended up talking too much about the problem. So you spent 3 minutes on the problem and now you're like, oh, and we have a great team, but I'll get to that later. No, you are who I'm investing in. I am investing in you to go execute. You can have the greatest product in the world. You can have the greatest market in the world. Failure to execute will send my investment to zero. So who are you? Why are you the CEO of this company? What expertise do you have? Who have you put around you? What expertise do they have? What resources can they bring in? Have they exited companies before? Is this your first rodeo? If it is your first rodeo, then who are your business advisors who have exited companies before and have done this before? Critically important if it's your first rodeo, because what you're embarking on is hard. It is a marathon, and you need to figure out how to keep as even keeled as possible, and insulating yourself around experienced people is very important. I will put a little note in here. Advisors are not attorneys and CPAs. They're just not. They are there to serve you. You are a customer of them. So keeping that in mind, 1. 2, they are trained to be inherently risk adverse. And everything that you are going and creating is risky. They're not going to help give you the best business advice possible. So they're going to give you what you want or what you want to hear necessarily, especially your attorney when it comes to your deal terms. And I'll get that in a moment. But business advisors are there to support you, the CEO, and how you build out those business advisors and how you choose to use those business advisors are critical to the success of your business. Now you have the board of directors. Board of directors is also important. They have a fiduciary responsibility to the investors, and they help with corporate governance. Corporate governance is key to any successful exited company. And if you do not have that in place, and if it's just you and your co-founder on the board, bring in someone else, especially as you bring in an investor. You can bring in someone who's not an investor that has expertise and knowledge. I always recommend having the investors represented. You can have people there to be board observers. The last thing you need on the board of directors is someone who's just going to tell you exactly what you need to hear. You need to be accountable to someone. You are accountable to the board. And if you're going to be bringing on outside capital, you need to take that into consideration. So spend some time here. I want to know who you are. I need nice, pretty pictures with smiling faces, nice little logos under each one. Because if you're going to ask me to read tiny font on that slide as you pitch, guess what? I've stopped listening to you talk. So, show me those pretty logos. Tell me why they're there. If you're running short on time, be sure to just go through the team members, and then you can always revisit the advisors and board of directors during the Q&A portion. If you're sitting here on the call and you're like, crap, I have a new company and I have no idea how to build a board of directors, I highly recommend the book Startup Boards by Brad Feld. He wrote a great book. It's a really easy read. Go read it, figure out, how you can start building a board and doing it as soon as possible if you're going to be bringing on outside capital. All right. Next, the deal. So now, keeping in mind, as I go through the slide order here, we've gone through problem, solution, market, go to market, barriers, competition. You have your financials, and then you have your team, because your team is the one that is actually going and executing on those financials. And then you have your deal, because I'm investing in the team. And that is the real reason why we have the deal come next. There are a lot of key things I'm going to be talking about here. This is so critically important. I cannot stress it enough. First of all, is all your paperwork done? Do you know what your deal is? Are you going out and raising capital and have no deal? You think you might have a convertible note, or you think you might have a safe note, or you think you might be going out for equity. Guess what? I'm not writing you a personal check. I need to actually write a check into an entity, into a company. So please make sure your paperwork is done and complete, and you understand at least what you're going to be going towards and how that's going to be affected. 2, have you read the deal? Do you understand the deal? I feel like a lot of the times, you know, the entrepreneurs get it from their attorney and they're like, great, thanks for that note, that convertible note, it's super, it's awesome. And they take it and they go try to fundraise on it. And they haven't read the deal terms. And I mean, and I'm not just talking about interest or the valuation cap or what that is. I'm talking about the fine lines. So, oh, if you exit before we convert, we only get a 2x. Talking about that. Talking about reps and warranties. I'm talking about, you know, pro rata. How are your investors affected by this, and how is it fair and balanced? As much as it is a frothy market out there right now, and we're seeing a lot of capital flowing into companies, investors do not put money into bad deals. It's the same thing with, you know, houses on the market that are overpriced and are not any good. They don't sell. You are selling equity in your company, whether it's in a note form or it's in true equity form. And the deal that you put forward will determine whether you spend 2 months doing it or a year. I've had companies come to me out of Silicon Valley. It's been funny. They're funny conversations sometimes, especially out of Silicon Valley. I will say, if you look at companies in Silicon Valley, they are not representative to the rest of the country. They just aren't. With how they think about valuations, with how they think about deal terms. One guy came to me and he was building out an MVP for a manufacturing type play, hardware product, and hardware's hard. No IP, no revenue, very small team, safe note with no maturation date or anything that comes with it, with a 10 million cap. And I basically laughed at him and said, well, good luck to you. And he's like, this is a good deal. And I'm like, I disagree. I very much disagree. And I would never invest in this opportunity. And I wish you the best of luck, because I would probably rate your company about 3 million with where you're at, you know, with the little that you've done. And so, you know, how this is expensive, and investors have worked hard for their money, and they're investing in you because they believe in you. But how do you make it fair and balanced? So what are your deal terms? I compare these in 3 different ways. And so, as I said, in my previous life, I sold real estate, and I never thought I'd actually use real estate and venture capital, but I do it all the time, especially when it comes to deals. You have equity. And so if you've ever gone and searched for a house, you know, you can see that houses are good. You like houses because when you buy a house, you get the land. So even if the house burns down, you still have the land. You are tied to that piece of property. That's what I call equity. Those are equity deals. Investors love investing in equity because they're tied directly to the success of the business from the get-go. Right from the start, you are brought them in, and they're there to support you and help see this through to success. There is condos. And condos typically, especially if they have a nice view, they're not as safe as a residential investment per se. But if you have a nice view and you're up on a higher level, it can be more protected if the market goes down, although the condo market will typically fall a little bit, but that view is protective. And that's what I call a convertible note. A convertible note usually has a maturation date in it. So it's typically 18 to 24 months. If I ever get 5-year notes, I usually have major questions about that. Why would you need a note for 5 years, or why would you want to have that be going on that long? Because there's interest involved. And there's also a discount on the conversion into equity. Notes are typically meant to be used as bridge rounds. And that's what they were designed to do. That's not what they do anymore, but that's what they were designed to do. And then you have safe notes, and safe notes were created by Y Combinator as a quick, easy vehicle to raise capital. I compare a safe note to the ground floor condo conversion that when you try to sell in a down market, you've already lost most of your value. It's broken into quite often, and you have to deal with vandals all the time. We typically don't look fondly upon safe notes because it's a simple agreement for future equity. It's very, very entrepreneur friendly. And when you're talking about creating fair and balanced deals with investors and competing out there in the marketplace that you're currently competing in for capital, it is not that fair and balanced of a deal. Now, that said, some safe notes are starting to look a little bit more like convertible notes, but still using safe note language. And then there's also post-money safes. If you are considering a safe note vehicle, the challenge for investors with safe notes is we have no idea how much we own when we buy into a safe note, and you typically have no idea how much of the company you're selling. And so there's a lot of unanswered questions. It's really meant to be quick and easy, and honestly, I don't think capital should come in that quick and easy. If you are going to go the safe note route versus a convertible note route, and there's many reasons why. Safe notes tend to be more conventional. Convertible notes can be a dime a dozen, but post-money safes can be a good opportunity to use them as a bridge, as a true bridge, because the investors do know exactly how much equity they're going to have with a post-money safe, and you as the entrepreneur need to stay true to what your valuation is and what your next capital raise is, and actually converting that safe over. So think about your deal terms, talk with your business advisors who have gone out there and raised capital before about what the strategy should be surrounding your deal terms, which vehicle you're going to be able to, use best with the stage of growth you're at. Because there's different vehicles meant for different stages. And then go to your attorney, and then talk to your attorney after you've talked to your business advisors, and tell your attorney what you're looking for and what you want to do. What you don't want to do is you just don't want to go to your attorney because you want to save your legal fees. And then you end up with a cap table that has 8 safes and 4 notes, and then you're trying to convert that over into equity. And, my brain is already bleeding from the math that needs to be done to figure out how much you actually have left in your company. There's huge implications here, and you need to understand what they are as the entrepreneur before you go forward. All right, and then let's get to valuation, because valuation is just one of many deal terms. It's the one that you hear most about. It's the one that investors stick to, and a lot of investors will confuse it, your cap as a valuation and whatever. Make sure your valuation is realistic. And once again, it's leveraging business advisors. You can go on Crunchbase and you can look at different things to see what, you think it should be. But really, your valuation is what the market will pay. And the market is the investors. So if you think about going back to the real estate analogies, you are searching for a house and you find a house in the most amazing neighborhood. It's gorgeous and it's such a good price now, but it's been on the market like 8 months. And you're like, what's wrong with it? Something's wrong with it. Everything in this market sells in a week. It's all gone. It's gone in a week. And you know that for a fact. You can look at the other comps. But this one's been on the market for 8 months. So, something must be wrong with that foundation, or, oh boy, they must have major sewer issues. Or maybe there's dry rot or black mold all throughout this house, or maybe the neighbors are horrible. You just start making stuff up, right? Same things happens with how you value your company. The faster you're able to bring in capital and close your round out, the more successful you're going to be. The faster you're going to get back to doing what you do best, which is building your company, because you're running two full-time jobs when you're fundraising. If you have a really high valuation because your ego tells you, well, it should be this because I'm worth this, but no one else is telling you are, that's great. It's a long road you have to go out and hoe there to do that. And the longer it takes you to raise that round, the more questions that are going to be asked by investors. And when you run out of cash, that's when you go out of business. So you really need to work with those business advisors on your full capitalization plan, understanding what your strategy is for each round that you're going after, and being very methodical about it, understanding that it might change and the numbers might change with the growth that happens. But if you go out too high and you're like, well, I brought in these investors, that's great. Well, how smart are these investors? Are they dumb money? Are they smart money? Do they add value? Do they add value to your cap table? Because if you just brought in a whole bunch of dumb money at a really high valuation, like the example I gave with the manufacturing play with the $10 million cap, well, then what happens when you don't meet those milestones? What happens when you don't achieve those goals and you need to go out and raise more money? You have to do a down round, and then you need to go back to that dumb money and tell them that, oh, sorry, I'm now not worth as much anymore. What kind of conversation is that going to be? So these are the things that you really need to think about as you're going out to raise capital and as you build out your deal. So understand your capitalization plan, understand your cap table. Who's on your cap table? Why are they there? Why are they important? Amber just launched a quick poll here. Go ahead and fill it out as you see fit. All right, continuing on. So you tell me all about the deal. You give me some really good deal terms. It's equity, participating preferred, a great valuation. You got more than half your round in. You know, I'm excited now. I'm interested. Okay, cool. You know, it's an interesting solution. It's got a good deal to go along with it, but what's the upside potential for me as the investor? And this is where you get to the exit. Why are you working so hard? Why are you, Mr. or Mrs. Entrepreneur, going out there and working so hard? And do you want to exit? Do you want to actually achieve that outcome and that goal? You need to understand what your exit strategy is. And if you come to me and you tell me it's 3 to 5 years, you and the other 20 companies that I just heard before you pitch will all tell me it's 3 to 5 years, when in all reality, it's probably 7 to 10. And I know this as an investor, but you can tell me it's 3 to 5 years, it's fine. But I want to know what your comps are. What research have you done? Who are those key relationships that you need to build? I would recommend building a separate board of advisors just for exit. Exit is hard. It takes time. It takes effort. And if you get a phone call in the middle of the night saying like, hey, I want to buy your company, chances are is you have no buyer at all and you're being lowballed for what is actually being offered. So there's a strategy behind this. And I think entrepreneurs lose sight. We get so focused on the ideation, the creation, the growth stage of the businesses that exit is just another phase in the whole company life cycle. And if you get to this point where you're at exit and you decide you don't want to exit, because I've actually heard stories from investors like this entrepreneur has changed their mind. They actually just want to keep running the business and they don't want to exit. How are you going to divest those investors? How are you going to get them their money back? There's lots of forms of exit. You know, there's IPO, there's M&A, there's divesting, there's failure. I mean, you know, let's be real. Be focused. Companies go on, they're like, well, I could M&A or IPO. Wrong. No. If you're building to IPO, you are building to IPO from the very moment you start. Because the amount of diligence and the amount of effort that goes into IPO, you have to have every single record possible, every single receipt, every single rent paper, every contract you've ever signed from the very beginning. So if you are going to IPO, that is a very specific route, and you better have people on your team who have done it before, because it's hard, and most IPOs I've seen have end up in an investor loss. Now, there's acquisition. Acquisition comes with its own, set of tricks and things, but they're built off of relationships. It can be the most clean. There can be acqui-hires involved with M&A. These are different things to think about as you build out your exit strategy and what this looks like for investors. If you're going out and pitching investors right now and you have no idea what this is, please stop and go back and rethink this, because this is why we're sitting and listening to you talk. And this is why we want to help you advance innovation, but make money at the same time. Because what we do as these investors here is once we make money back, we turn around and we go invest in more companies. You can't take money out of the ecosystem and not have a place for it to go. It needs to go somewhere. And after you get done telling me what your house in the middle of the Pacific is going to look like after you exit and you're enjoying yourself and taking your break, then what I need from you is just a summary. In closing, running through all the accomplishments you've had to date. And so if you were worried that I might have forgotten about your solution and what you did, or your happy customers and how much revenue you've had, and all the things that you've talked about at the beginning of your pitch, you now can just tell me about those once again. We've done X, we've done Y, we've done Z, we have this many patents, we've filed for this many provisionals, we have this many customers, and advertise here. You can show awards, accolades, use lots of logos and pretty pictures. This is where you're going. This is what you're doing. And this is what's going to generate interest. Now, if you are building a due diligence team with us, this is where you ask for due diligence help. If you are needing us to complete a poll, ask us to invest. Ask us to complete the interest poll. You need to ask. If you don't ask for things, guess what? We're not going to give it to you. You have to ask. I actually was in a fascinating talk yesterday, and this woman said the same part in your brain that experiences pain is the same part in your brain that you use to ask for help. And so it is a cycle that actually feeds itself. We don't ask for help because we think it's going to cause pain. But in reality, most people want to help. You've got to ask for help. You've got to ask for the things you need. If you do not ask, you're not going to receive. So in quick conclusion here, some things that I think are kind of key takeaways for you, because it's a lot to digest and I just got done barking at you for the last hour, is your pitch should only be an overview. You're meant to generate interest. The qualifying comes down the road later. And so, small milestones to bite off as you continue to, on your journey. Know your audience before you reach out. Why are you going to this group? What value do they have to bring to the table? What investors do you want to bring in? What backgrounds and expertise do they need to have? Why are you putting them there? Or, just going out to everybody is not a good strategy. Are your documents done, and do you understand your deal terms? Remembering that I care about the solution. I don't really care about the problem. You are the best at what you do every single day. And so stay out of the weeds, because if you start diving down these really interesting rabbit holes, you start creating like red flags start going off in like a pinball game. Bing, 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 bing. It's too much. I don't understand what you do. You need to, as Volker's on the call today, talk to me like I'm 6. Talk to me like I'm 6. Seriously. You're the best at what you do. Bring me along for that journey. Less words, more pictures. Know your capitalization plan and know it inside and out, all the way to exit. How much capital do you fully need to raise to be successful? At what point do you just start reinvesting in the business from the revenue you're bringing in? And your exit strategy, being realistic about that timing. And then lastly, and probably the most important, is just be coachable. Don't have all the answers. It's okay to not know all the answers. We actually appreciate that as investors. That's a great question. I haven't gotten that before. I would love to get your name and your email, and I'll follow up with you and get you that answer. It's also a great follow-up point. So that is what I've got for you today. I really appreciate you all being on and being on the line and learning more about what we think about as investors as we look at these different opportunities. So thank you all for being on the line today. I wish you all good luck as you go out there and do hard things. And we need more people like you doing this stuff. And so we're always here to support and help. Glad you could listen in and learn a few things.